Have you ever really stopped to think about what a product truly costs to make? I mean, sure, you can add up the obvious stuff, right? The wood, the screws, the time someone spent physically putting it together. But what about all those hidden costs? The factory's electricity bill, the supervisor's salary, the insurance. Getting that number wrong, well, it can literally sink a business. So today, let's dive in and figure out how to find that true cost by properly allocating overhead.
We're going to break this all down into 4 pretty simple steps. First up, we'll uncover those hidden factory costs. Then we're going to create a simple formula to get a handle on them. After that, we'll see how to put that formula to work on the factory floor. And finally, the moment of truth. We'll see what happens when our careful estimates meet cold, hard reality. So, let's kick things off with part 1, the hidden factory costs. This is all about shining a big old spotlight on all those expenses that are absolutely essential for production, but, well, they're just not easy to trace back to one single product.
Think about it like this. If you're making a wooden chair, the cost of the wood is a no-brainer. That's a direct material. And the wages for the person cutting and assembling that chair, that's direct labor. Easy. But what about everything else? How much of the factory's monthly rent actually belongs to that one chair? That's the million-dollar question we've got to answer.
And that brings us to the key term for today, manufacturing overhead. It's really just the official name for this big bucket of other costs. The rule is simple. If it's a cost of manufacturing, but it's not direct materials or direct labor, boom, it's overhead. So what's actually in this bucket? Well, it breaks down into a few main categories. You've got your indirect materials, things like polishing compounds, cleaning supplies, or welding rods. Then there's indirect labor. We're talking about the wages for the maintenance crew, the janitors, the factory security guards. And then you have the whole shebang of factory operating costs, stuff like utilities, insurance, and property taxes for the factory itself. So here's how a company starts to get organized. At the very beginning of the year, they estimate all these different costs and pull them together into 2 main groups. First, you have variable overhead. These are costs like utilities that tend to go up or down with how much you're producing. And then you have fixed overhead, which stays the same no matter what. Think rent and insurance. This initial estimate is our crucial starting point for everything that follows.
Okay, so we've got this giant pile of estimated costs. Now what do we do with it? Let's move on to part 2 and see how we can turn that pile into a practical, useful tool with a rate-setting formula.
So how do we connect that big pile of costs to a single product? We can't just guess. We need a logical link, something called an allocation base, or what accountants like to call a cost driver. This is basically an activity that causes the overhead costs to happen in the first place. For a factory that's really labor-heavy, it might be direct labor hours. But for a factory that's full of automated machines, it's almost certainly going to be machine hours. That cause and effect relationship is absolutely everything. And you know what? The math is actually pretty simple. To get our predetermined overhead rate, we just take our total estimated overhead for the year and divide it by our total estimated allocation base, like those machine hours we just talked about. We've just got to do this once for our variable costs and once for our fixed costs. Let's make this real with some numbers. Here, the company takes its estimated variable costs and divides them by the number of units they plan to make. Then, for the fixed costs, they divide by the number of machine hours they expect to run. What this does is give them a specific dollar rate for each type of overhead. Now we have our tools, we're ready to go.
All right, we've done all the prep work, we've calculated our rates. It's time for part 3, putting the rate to work. This is where we take these numbers from the spreadsheet and bring them down to the actual factory floor.
Now, a company has a big choice to make here. They could use one simple plant-wide rate for the entire factory. It's super easy, but it can be really inaccurate. The other option is to use separate departmental rates. Yeah, it's more work, but it's way, way more accurate, especially if, say, one department is all about hands-on labor and another is packed with automated machines. And just look at this. This is why that choice matters so much. Using one single rate for the whole factory would be easy, but it would just be wrong. By creating separate rates, the company gets a much clearer, more accurate picture of what's really going on. A product made in the automated department gets a totally different overhead cost than one made in the manual department. This is absolutely key for getting your pricing right. So here's how it works day to day. Throughout the year, as products are actually being made, the company applies those rates we calculated to the actual work being done. For every unit that gets produced, or every hour a machine runs, a little bit of that overhead cost gets attached to that product's total cost. This is how all those hidden costs finally become part of the product's official cost on the books.
All right, we've been applying our estimated rates all year long. But now, The year is over, and it's time for the moment of truth. Let's head into our final section, truing up the numbers. This is where our careful estimates finally have to face the cold, hard facts of what actually happened. When we compare the total overhead we applied to products to what we actually spent, there are really only two possible outcomes. If we applied more than we spent, it's called overapplied, and if we applied less than we spent, you guessed it, it's called underapplied. One means our products were slightly overcosted during the year. The other means they were undercosted.
It really is that simple. If the applied amount is greater than the actual cost, it's overapplied. If it's less, it's underapplied. And that gap, that difference between our estimate and reality, has a name. It's called a variance.
Okay, so you've found a variance. The big question is, now what? What do you actually do about it? Well, the path you take next depends entirely on one single thing. Is the amount of that variance significant? Is it big enough to matter?
Let's start with the easy path. If the amount is small, what accountants call immaterial, the fix is incredibly simple. You just close out the entire variance directly to one account, cost of goods sold, and you're done.
Here's a perfect example. This company was a little under on one estimate, a little over on another. The net difference was only $3,000. Since that's considered insignificant, they just add that amount to their cost of goods sold for the year to make the books balance. Easy peasy.
But what if the number is big? What if it's a significant amount that could actually mislead someone who's reading the financial statements? Well, in that case, we need a much more precise method called proration.
So what happens when the variance is huge? Look at this, an $85,000 difference. That is way too big to just dump into one account. So instead, the company prorates it. They basically spread it out proportionally across all the places that overhead ended up. A piece of the correction goes to inventory that's still being worked on, a piece goes to finished products sitting on the shelf, and the rest goes to the products that were already sold. This gives a much more accurate financial picture in the end.
But listen, this is so much more than just a bookkeeping chore at the end of the year. That variance is a powerful signal. It's an alert to management that reality didn't match the plan. Did they produce way more or way less than they expected? Were their utility costs way higher than they budgeted for? Finding the variance isn't the end of the process. It's the start of asking much better questions.
Which brings us right back to the final and most important question. After all this work, you finally have a much better handle on a product's true cost. So what now? How does that new knowledge change your pricing strategy, your production decisions, how you view which products are really profitable and which ones aren't? That's where accounting stops being about numbers and starts becoming strategy.